Okay, so for this week, Chapter 9, we are going to focus on long-term liabilities. Most of this chapter is pretty straightforward. Until we get to talking about bonds, it can get tricky, but that's why you're here. We're going to really work together. So it takes the guesswork or the complexity out of bonds. So you see here, with bonds, a bond is generally long-term or debt that is due beyond a year. Okay? So a short-term liability would be, or a current liability would be due within the current operating cycle. Long-term liabilities, their maturity happens over this coming year. Know that when companies are trying to grow or gather money in order for different purposes, there's various alternatives that they may utilize in order to get money. When we talk about the term capital structure means companies will do a mixture of taking out loans or borrowing money versus gaining more stockholders or shareholders to gain money in that respect. So you know, when you are a part owner of a company, you invest in that company in order to gain a piece of their profits. But you pay stock to invest in that company, and that stock is given to that company, and they may utilize that stock to help grow the company. Another way companies get cash is by borrowing money. So when we talk about debt financing, it's when we go and borrow money, be it big bonds where you borrow money or go to a bank. Equity financing is when you go and gain new shareholders to get cash. The capital structure is what's the mix a company uses. Does a company try to get more shareholders in which to gain the cash they need, or do they go and borrow money? No. One advantage of borrowing money by debt is that the interest on those funds is tax deductible. We know when a company pays dividends to the shareholders, it's not deductible, is it? The dividends are part of the statement of stockholders' equity, right? Under the retained earnings portion, where we subtract that from the retained earnings. So while the equity piece for gathering more stockholders may seem beneficial, it can generally be more costly because they deserve a piece of the profits instead of just paying back on debt. Okay? So there's a trade-off. Many companies utilize various forms of financing a company. We know which of the following statements are true. Interest paid on debt is a tax-deductible expense. Dividends are not tax deductible. They're not tax deductible. It's a portion of the retained earnings they're subtracted from. So when companies choose to use debt financing, such as a car loan, most often when there is financing involved, the person or the company pays a monthly note. This is called an installment note. Most car loans and home loans call for payments in monthly installments rather than by a single amount at maturity. Each installment payment includes amounts that represent both the interest on the borrowed amount and paying down the loan balance. Okay? So here's an example, guys. Assume a $25,000 6% 4-year loan for a new delivery truck on January 1st, 2018. Payments of $587.13 are required at the end of each month for 48 months. So you'll see the first payment of $587.13 shows $125 of it being interest. Now we know it's $125 because if we take the $25,000 times 6% times 1/12 or 1 month out of 12 months, it's only it's $125. If we take the payment of $587.13, subtract the interest amount, the rest goes to reducing the loan balance. Okay? So then at the end of the first month, the new loan balance is at $24,537.87. So then for the second month, they're going to pay interest on $24,537.87 times 6 months, 6% times 1/12, and that's $122.69. So the amount they pay is going to stay constant. The $587.13 stays constant. But since this interest has gone down a little because the note went down, do you see the $587.13 minus the $122.69? That balance is what the note is reduced. So now we get to take $464.44 and subtract that from the current loan balance to get a new carrying value on the loan of $24,073.74. And it continues on and on and on for 4 years until, look at the very end. Before the very last month, the carrying value on the loan was $584.21. When we do that final payment of $587.13, the interest on that $582.21 carrying value is $2.92. The rest goes to pay off the loan. We're down to zero. Do you see how that works? This is called an amortization schedule that allows us to see exactly what the loan balance is each month, and we can clearly see what portion of that payment goes to interest and what portion goes to reducing the loan amount. So when we initially create a loan, we'll debit our cash and we'll credit our notes payable. Then in the first month, we're going to have 3 different accounts we need to adjust for. One is interest expense of the $125. One portion is reducing our note payable by what we're paying down on the note. For the first payment, it was $462.13, and we credit cash for the full amount. So each month, guys, the cash amount's going to stay the same, but the interest expense and the notes payable will shift each month. Okay? questions on that before we move on? Does that kind of make sense, guys? Most notes payable require periodic installment payments. Each installment payment includes an amount that represents interest expense and an amount that represents a reduction of the outstanding loan balance. So guys, I want you to take a minute and attempt this. Tropical Paradise borrows $24,000 and agrees to a 5% 5-year installment loan with the bank. Payments of $452.91 are due at the end of each month. How much interest should be recorded for the first month? And you know I'm not going to call on you because I want you to be here. I don't want to put anyone on the spot. But if you choose to answer, that would be awesome. Okay, guys. Anyone have the right answer? B, 100? That makes sense? So the 24,000 times 5% times 112 gives you the $100. Here we're going to look at this problem. On January 1st, 2018, Stoops Entertainment purchases a building for $610,000. Paying $110,000 down and borrowing the remaining $500,000, signing a 9% 15-year mortgage. Installment payments of $5,071.33 are due at the end of each month, with the first payment due on January 31st, 2018. So what we're going to do is do a journal entry to record purchasing the building, complete 3 rows of an amortization schedule. So to purchase the building for $610,000, we'll debit our asset building for $610,000. Since we put down $110,000 in cash, we'll credit our cash for $110,000, and the difference will be a credit to notes payable, which is a long-term debt. Okay, 15-year mortgage. This is the journal entry we will show that shows the purchase of the building and how we're financing it. Okay? Then, for the amortization schedule, we're starting out with a carrying value of $500,000. They told us our payment is going to be $5,071.33 each month. The way we figure out the interest is by taking the $500,000 times 9% times 1 month out of 12 months, or $3,750. The way we know the decrease in carrying value is actually a plug-in, guys. It's what our payment is minus the interest. That difference is going to pay down or reduce the mortgage. So we see that balance of $1,321.33 reduces the loan balance. So $500,000 minus the $1,321.33 shows a carrying value now of $498,678.67. So when the next payment occurs, the interest is now only on the $498,678.67, right? So the $498,678.67 times 9% times 112 is now $3,740.09. So you see, as the interest goes down, the carrying value, the amount we apply towards the loan, is going to increase. Any questions on how this amortization schedule works? Okay. Then the journal entry we will show for the first month has 3 parts to it again, 3 accounts. The interest expense is debited, because we know all expenses are debit balances. The amount that we're paying down on the note is a debit, because a payable is normally a credit balance, isn't it? So when we reduce a payable, we debit it. And then we credit our cash. Okay? So we debit our interest expense from the amortization schedule. We debit the notes payable from the amortization schedule. And the cash balance, the credit to cash will continually be the same. Okay? Any questions, guys? Is it kind of making sense? Now, it says total payments over the 15 years are $912,639. So if you think about it, guys, if we pay $5,071.33 for 15 years times 12 months, it's 180 payments. And we know if the mortgage is at $500,000, won't all the rest go to interest? You see how that kind of makes sense? If we're going to make a payment of $5,071.33 for 180 months, and we know the principal balance is $500,000, wouldn't it make sense the rest all goes to interest? Okay? Now, we started talking about different ways that companies finance. Some with equity financing, some with debt financing. And what I'm going to help you understand is that if one company chooses one method and one company chooses another method, and you know, it's all about comparing between companies to see who's got the better ratios. That, depending on how they do it, is going to affect their ratios. We know of leases when someone, how many of you guys lease an apartment or lease a house? Okay? So you have the ability to use that property, but you don't own it. Okay? So a lease is a contractual arrangement by which the lessor, who's the owner, provides the lessee, the user, the right to use an asset for a specific period of time. Now, what most people are familiar with are what we call operating leases. The lessor, the owner, owns the asset, and the lessee simply uses the asset temporarily. Makes sense. People do it with apartments. People, like I rent some office space. I don't own the office space. My landlord's name is Wu. Wu gets calls from me all the time because he's always working on the building, and it just like the whole place vibrates when they're drilling. But Wu owns the building. I just pay him $3,000 a month to use my little square footage area. Okay? I have no plans to buy that building. I just want to rent my space. That's a normal lease. But businesses have gotten creative over time and come up with another type of lease called a capital lease. That's where the lessee really buys an asset, but borrows all the money through a lease to pay for the asset. Okay? So it's a way initially of saying they're leasing the asset. But with a capital lease, the intent is for them to use this asset, not just temporarily, but for the life of the asset. Therefore, when you are involved in a capital lease, we have to treat it different than if it is just an operating lease. Now, why do companies lease rather than buy? Well, leasing helps cash flow. If you can finance 100% of what you're buying, it's less money you have to put down. Okay? In a purchase, most lenders require a down payment up to 20%. Leasing allows you to finance the entire purchase, freeing that cash for other purposes. Here's the other catch. We're going to see why. Leasing improves the balance sheet by reducing long-term debt. You'll see what I'm talking about when we start comparing ratios. And leasing lowers income taxes. Many companies find that purchasing equipment causes them to be faced with an extra income tax burden on something called AMT, which is kind of going away, honestly. Because I do taxes, I know that piece is being changed a bit. Leasing helps avoid some additional taxes. But leasing, if you think about it, you get to write off that rent. Where when you own an asset, you depreciate a portion of it, so that helps. But that's pretty much the only thing you get to write off is depreciating that portion. So this is just showing you Six Flags has a lot of leases. But here's the key. An operating lease is truly leasing an asset temporarily. A capital lease is just a manner in which you get to finance 100% of it. But with a capital lease, you can't just show that as an expense because you're truly buying the asset. So what happens with a capital lease is your assets increase, but your debt increases as much as your assets increase. So do you see when you have an operating lease, if your assets are $100,000 and you're leasing something, nothing changes there, and your debt doesn't change. So if your assets are sitting at $100 million and your liabilities are at 60 and your stockholders' equity is at 40, do you see that your debt to equity, the 60 divided by the 40, would be a ratio of 1.5? okay? If you take out a capital lease, though, what would happen is now your assets are 110. Your liabilities went from 60 to 70. But your equity stays the same at 40. So do you see now your debt to equity ratio, 70 divided by 40, is 1.75? Where under an operating lease, a company who chooses to lease, they look better as far as the ratios look, debt to equity, than would a company who has a capital lease. Because by financing 100% of it, their assets increase, but their debt increases also, which harms their debt to equity ratio if they're to compare themselves to someone who did it another way. Does that make sense? The ratio of liability to stockholders' equity is higher under a capital lease. Remember, guys, an operating lease is recorded just like rental. In a capital lease, the lessee essentially buys the asset and borrows the money to pay for it. So, guys, which of the following leases is essentially the purchase of an asset with debt financing? Excellent. Capital. Okay? Here we're going to look at this exercise. Coney Island enters into a lease agreement for a new ride valued at $2 million. Prior to this agreement, the company's total assets are $25 million and its total liabilities are $15 million. Calculate the total stockholders' equity prior to the lease agreement, not lease, sorry guys. Assuming an operating lease, calculate the debt to equity ratio. So guys, if total assets are $25 million and liabilities are 15, let's go back to that accounting equation. Assets equal liabilities plus stockholders' equity. So stockholders' equity has to be 10, right? So the 15 divided by 10 would be a ratio of 1.5, right? If they do a capital lease, do you see their liabilities are going to go up to 17 million? So their stockholders' equity is still at 10 million. Do you see how that liabilities divided by stockholders' equity, 17 divided by 10 is 1.7? How it increases the debt to equity ratio, which is a negative. That means that's their debt to equity ratio, which is higher than if they would just do an operating lease. Any questions on that? Sorry, guys. Okay. Why might Coney Island prefer an operating lease? Well, it's because it would keep the debt to equity ratio more favorable than by doing a capital lease. So, in that respect, pretty straightforward. Installment notes. Pretty easy. Now we're going to talk about bonds. We're going to get into some aspects of bonds today, and then next week go through this again, and then next week we'll talk about when we dispose of bonds, okay? So bonds. Bonds are a formal debt instrument that obligates the borrower to repay a stated amount, referred to as the principal or face amount, at a specified maturity date. The borrower also agrees to pay interest over the life of the bond. Traditionally, interest on bonds is paid twice a year. So, unlike installment agreements where they're paid every month, bonds are generally paid twice a year. Okay, June and December. Traditionally, interest on bonds is paid twice a year on designated interest dates beginning 6 months after the original bond issue date. Now, a bond is just a lot of money they're borrowing over a longer period of time. There are various types of bonds. Bonds can be secured, which means backed by collateral, or unsecured, not backed by collateral. Now, logically speaking, a bond that is secured is going to probably have a better interest rate than one that isn't secured, right? Because in case of default, they've got something. Bonds can be term bonds, which means the bond all issue matures on a single date, or they can be what's called a serial bond. It matures in installments. Bonds can be callable, which means it allows the borrower to pay them off early. Bonds can also be called convertible, which means if the borrower doesn't have enough money, they can give you stock in lieu of paying you cash back. Okay? So it's important that you know all this. Okay? The distinguishing characteristic of bonds include whether they're backed by collateral or not, secured versus unsecured, become due at a single specified date or over a series of years, term or serial, can be redeemed prior to maturity, callable, or can be converted into common stock, which would be convertible. Okay? So which of the following bonds always matures on a single date? Term. Now, this is where it gets goofy. How much do they determine to issue a bond for? Here's the deal, guys. When there's a bond, California Coasters is raising money for a new roller coaster. It's issuing $100,000 of bonds, paying a stated interest rate of 7%. The bonds are due in 10 years, with interest payable semi-annual on June 30th and December 31st each year. Here's the catch. This bond is just a piece of paper. I know wrong one. I know online you're not going to be able to see this. I guess I should do it online, shouldn't I? You know what? I'm going to do it online so you can see what I'm talking about. So, the bond is just a piece of paper. And it has on this bond, let me just kind of, so this just piece of paper is going to look like, let's just say, bond, okay? And it's going to have a date. And it's going to say on this piece of paper, the stated interest rate is 7%. It's just a number on this piece of paper, okay? It has nothing to do with what's really going on in the world. Got it? But that stated interest rate just allows you to know what you're going to get paid every 6 months. Okay? But it doesn't mean what really is happening right now. So from a year ago, the interest rates right now, just like to borrow a home, are at like 8 to 9%. A year ago, what were they at? 5, maybe 6%? That's what's happening. That's like what you really borrow money for. But this bond just is a piece of paper that has this number that allows you to know how much you're going to get each month, each 6 months. Okay? So know when we talk about a stated interest rate, see the stated interest rate? It has nothing to do with the market's really bearing. It's just the number that's on the bond piece of paper. Okay? Now, what happens is the face amount on this bond is $100,000. When the stated rate shows 7%, all that means is that the bond's at $100,000 and the bond is an annual rate of 7%, that means they're going to receive $7,000 a year or $3,500 every 6 months. Do you see what that means? No, that's all the stated rate means. It's nothing with the real world. Okay? It's just letting you know this is what they're going to get as a payment every 6 months. Okay? So when a bond happens, the borrower gives a certain amount of money, and they're going to get $3,500 each month for the next 10 years. Excuse me, not each month, twice a year. This is not an installment, Nancy. Twice a year for the next 10 years. But how much do they have to give to get this? Well, what happens is that depends on what we call the market rate. The amount investors are willing to pay for a bond is what we call the issue price. So, know that the face amount is the amount that's showing up on the bond. The interest payment is determined by that stated rate on the bond times a half a year. But here's what matters. What's the market rate? What's really happening out in the real world? The market rate is going to determine what someone's willing to pay for this bond. Make sense? So, if the stated rate, what's shown on the face of the bond, and the market rate are the same, well, then people are going to buy this bond for what the face amount shows, $100,000. Okay? And we'll talk about Excel in a minute. But if the market rate is sitting at 8%, but the stated rate, just that number on that bond paper, which means nothing but just shows you what the payments are going to be every 6 months. If the market rate is greater than the stated rate, someone's not going to pay $100,000 for this bond, right? They want to get what the market is bearing. If the market is going for 8%, well, an investor isn't going to give the borrower $100,000. It's going to give them $93,000 with the hopes of getting 100,000 at the end. Why? Because they want what the market will bear. The market rate is greater than what's showing on that piece of paper. Therefore, an investor is going to spend less than the face amount in order to make up that 1% interest rate. Does that make sense? What if, let's just say, the stated rate sitting on that piece of paper, what you're going to get paid every 6 months, is 7%. But the market rate is at 6%. Okay? In that case, they're going to have to pay $107,000 up front in order to get $100,000 at the end. Why? Because the market rate is less than what the stated rate is. Therefore, they're going to have to pay more for that investment in order for it to make sense, for them to, what the market's willing to bear. They're going to end up getting paid more, and as a result, they're going to have to buy that bond for a greater amount. Now, where it's nice is instead of having to figure this out, we have two ways to determine how we figure out what the issue price is. The first thing we can do is we go to Excel. Okay, so here's our information that we have. We've got the face amount, we've got the interest payment, we've got the market rate, and the number of periods. So what we're going to do here, guys, we're going to go to Excel. We're going to go to Formulas, Financial, Net Present Value. We're going to show the rate. The rate is always the market rate, what's really going on in the real world. And if they say the market rate is 7% annually, what does that mean twice a year? 3.5%, right? So the rate, 0.035. Do I have the right one? Let me just see. Present value. No, I'm at net present value. I want present value. I want present value. So Formulas, Financial, Present Value. The rate is the semi-annual interest rate, the number of periods. Think of this, even though it says 10 years, how many times are they going to get paid each year? Twice a year. So 10 times 2 is how many periods? 20. The payment, remember the payment is the amount on the bond times that stated interest rate. What was it? 3,500? I did something wrong. This always happens when I haven't done it in a while. Present value. Stated rate, 0.035, 20 periods. What am I doing wrong? Market rate, 0.035, 3,500. Oh, the face amount. I don't think I showed the face amount in here. Let me try it again. Future value, okay. 0.035 is the interest rate, 20 periods. Payment, I think I need to put a minus on this so it does what I want it to do. And what am I going to see at the end? That 100,000. Remember? That will then show... the rate, 0.035, 20, 3,500. We'll end up with 100,000, right? Whew. Seventh time is a charm. Okay? So if you use that present value formula, you can then figure out what the issue price is. In this case, if the stated rate is the same as the market rate, they're going to issue for face value, right? But now let's go to this next example. If we say that the market rate is 8%, okay? The market rate is over the stated rate. Then what are we going to do here? We will financial present value. The rate is 8%. Twice a year is 4%, right? The number of periods, 20. The payment, 3,500. The amount, face value, 100,000, right? Do you see it shows us if the market rate's sitting at 8% and the stated rate of what we're going to get paid is 3,500 each 6 months, we would buy that bond for $93,204.84 in order to get that 8% rate. Make sense? Think of this as an investment. You want to get the best deal you can. Okay? So you're not going to just take what is on a piece of paper. You're going to take what the market's willing to bear. Got it? So if the market's at 8, but you're getting paid the $3,500 every 6 months, you're only going to pay $93,000 to eventually get $100,000 on that money, because that extra 1% interest rate is in that issued discount. Make sense? Now let's do it another way. We go to the present value. Let's say now the market rate is only 6%, which is twice a year, 0.03, 20 periods. The payment is still $3,500 with 100,000. And do you see in that case, if the market rate is less than what the stated rate is, you would have to pay $107,438.74 because you're getting more interest than what the market's willing to bear. So the person who's selling these bonds to you wants the market rate. They're not going to pay you more than what they're required to pay you from the market. Does that make sense why the issue price is different? It's a goofy way of doing it. It's just the way they do it. Okay? But guys, the big key here is know that the face amount is what's sitting on the piece of paper on the bonds. The interest payment you get, That's where the stated rate comes into play. It's the face amount on the bonds times that stated rate sitting on the bonds times half of a year. And that's what you get paid every 6 months. That's all the stated rate's being used for. Don't think of that stated rate as what's really going on. That stated rate is just being used to show you the payment. And then know the key is the market rate. Okay? Does that make sense? Now, another way that you can figure out what how to price bonds is you go to 2 different tables in your book. In the back of the book, there are 2 tables. Let me just go here, guys, and show you. If you go to the book, and you go to table of contents, the back of the book, there are appendixes. I believe there should be 2 tables. Table 2 and I think table 4 is what we want to use. Well, it's the only bummer with not having the hard copy on hand. I thought it was let me see. I know it's in the appendix. I thought it would have been in the time value of money. There's a table 2 and a table 4. Investments, time value of money. I'll find it and I will send it to you guys, what page it is on, or I might just even put it in the announcements so you have the 2 tables. But basically what happens, there's a table. The table allows you to do it the way Excel did it. I think Excel's easier. The table 2 is called, the table is called the present value of a single annuity or a dollar. And not an annuity, of a single amount. And that table, if you go and you look at where the period is 4%, excuse me, the interest rate is 4%, but the number of periods is 20, you will scroll and you will find that the factor is 0.45639. Okay? You know what I'm going to do? I'm just going to do it this way. I'm going to do it this way. Table of a single value of a dollar. Present value of a dollar table. So what happens is you get this present value of a dollar table and you look at where, if the interest rate is 4 and the number of periods is 20, do you see right here, there's a factor here, 0.4564, which should be what we had right here, 5569. They only put it out a little bit. So you'd use that factor to come up with what is the present value of that $100,000. Then you go to table 4, which is called present value of an annuity. And what that annuity means is that $3,500 payment every 6 months. Okay? Remember that $3,500 payment every 6 months. You're going to figure out what's the present value of getting that 20 times. So you go to the table 4 where it will show you the interest rate and the number of periods, but you have to use a different table, present value of an annuity. And that gives you the factor 13.59033. You multiply that payment you're going to receive every 6 months times the 13.59033 and get $47,566. You add the two together, you're going to get the same as you will on the Excel table. So there's 2 different ways you can do it. In your homework, guys, the tables open up for you. Okay? So when you go to do your homework, let me just show you what I'm talking about. When you go to do your homework, chapter 9, and you've got a problem to do, and they want you to do the present value, there will be, well, I'm not seeing it here, but when you're in your student view, you'll click on the table and it will open up for you. Okay, guys? I would do both. I would try the Excel and I would try the table just to confirm you got the right numbers. So moving on. Again, what we're talking about is how we price bonds. No, the face amount is what's sitting on the bond. The stated interest rate is what's on the bond, and it only helps you know how much you're going to get paid twice a year. The market rate is what is actually happening in the world as far as rates. And the number of periods isn't just the number of years, it's the number of years times how many payments each year. Does that make sense, guys? The interest rate we use to calculate the bond issue price is always the market rate. Never, ever, ever the stated rate. Some students get confused and incorrectly use the stated rate to calculate the present value. Don't you dare. It means nothing. Okay? You know I'm joking, right? Use the stated rate only to calculate the interest payment each period, but use the market rate to calculate the present value of the cash flows. Okay? So, know this. And guys, I would save this slide or write this down. Know that bonds will be always issued at a discount if the stated interest rate is less than the market rate. Bonds will always be issued at a premium if the stated interest rate is greater than the market rate. And they'll be issued at face amount if the stated rate is equal to the market rate. Does that make sense? Yes? No? This is an important slide. It will just help you cement, when you can't think it through, how to do it. What about this, guys? If a 10-year bond is issued with a stated rate of 9%, when the market rate is 8%, the bonds will be issued at what? They would be issued for a what? Okay, look at that piece of paper we just did. Premium. Let's look at this exercise. On January 1st, 2018, Waterworld issues 26 million of 7% bonds due in 10 years with interest payable semi-annually on June 30th and December 31st each year. Waterworld intends to use the funds to build the world's largest water avalanche and the tornado, a giant outdoor vortex in which riders spin in progressively small and faster circles until they, oh, that sounds dreadful, drop through a tunnel. If the market rate is 6% and the stated rate is 7%, will the bonds issue at face amount, a discount, or a premium? So remember, go back to this sheet of paper. Okay? Do you see why this one's great? Because it just helps you remember. They're going to go discount, premium, or the same. In this case, the stated rate is 7, the market is 6. That means you're going to pay more for these bonds. You can, any of you guys, none of y'all have computers on you. So, if I go in, the reason I know the payment is going to be $910,000 every 6 months is I say 26 million times 3.5% is going to give me $910,000. That's the payment amount. The market rate is 6% annually, which means 3% every 6 months. The number of periods, 10 years, but you're getting paid twice a year, that's 20 periods. If you plug this in, they're going to tell you the issue price is $27,934,072. Okay? If the stated rate is the same as the market rate, easy, right? If the stated rate is less than the market rate, then you're going to pay less. You're going to buy that for less because you want to get what the market is willing to bear. Right? Guys, any questions? Do you understand where people get it confused though? No, you use the market rate to determine interest. The only thing the stated rate is used for is to calculate how much you're going to get in that payment every 6 months. Now, how do we go about recording these bonds? When we know what we're going to issue the bonds for, we're going to show if the market rate and the stated rate is the same. It's easy. We debit our cash, we credit our bonds payable. And then every payment is going to be the same. Interest expense will be the full $3,500 and cash is $3,500. Easy. When the stated rate and the market rate are equal match, piece of cake. However, when the stated rate is not the same as the market rate, it's a little more challenging. In this case, the face value of the bonds are $100,000. The bonds are paying, when they say a 7% interest, all that means is they're getting paid $7,000 a year or $3,500 every 6 months. But if the market rate is sitting at 8% and you figure out the present value of these bonds, it'll tell you we're only going to pay $93,205 for these bonds. So the cash is going to be only $93,205. The bonds payable is $100,000, and that extra money that we call discount on bonds payable is going to be used to pay the interest, and you'll see why in a minute. Okay? Remember, the stated rate is 7%, but the market is higher. Therefore, that's why we're only going to give them $93,205 if we're the investor to buy these bonds for. Okay? Now, here's where it gets tricky. The first, excuse me one sec. On the balance sheet, yes, we have $100,000 bonds. But on January 1st of 2018, the bonds only show a carrying value of $93,205 because that's what we bought them for, or that's what they were purchased for. Okay? Do you see how that discount gets subtracted from those bonds? Now, how does the payment work? Let's understand this. Think of an installment, an amortization schedule. Even though we said the bonds at face amount were $100,000, right now they're only sitting at $93,205. Okay? So let me just show you this way. Let's do an amortization schedule. And we've got the cash payment, which is $3,500, right? We've got the interest. We've got reduction of, the discount. And we've got the face amount. Isn't the face amount $93,205? Right? The interest, guys, isn't that going to be $93,205 times 4%? Right? So do you guys see here? Am I doing it right, the discount? Yeah, I'm doing this one right. So in this case, the interest is showing at $37.28, right? The interest is showing at $37.28. But guys, what are we getting? We're getting $3,500, right? Do you see how the interest is more than what we're really getting paid? Which is why we didn't pay the full amount for the bonds. We only paid $93,000. So that discount is used to add to, I should have brought all this down one. Cut. So the discount is being used, let me just do it this way. Equal this minus this. The discount is needed to take care of the interest. We're getting paid $3,500. The interest is $37.28. So the difference between the cash payment and the interest gets added to the carrying value of the loan. So now The next time, the next semi-annual payment, this is going to be our new face amount, $93,433 times 4%. The discount now is $237.32, which means the amount we received in cash didn't cover the interest payment. So, do you see how our carrying value on our loan keeps increasing? See what it's doing? And it's going to keep increasing. To where after 20 periods, it's going to go up to 100,000. So what's happening here, guys? Let me just copy. Oops, I don't need this one. Do you see over those 20 periods, we do our amortization schedule. We start our interest at the carrying amount of the loan. We show the interest rate here to be 8%, right? Or excuse me, 4%, because it's twice a year. This is just the cash payment. This is the 100,000 times 3.5%. The discount is the interest minus the cash payment. And then the face amount, that discount less cash payment, keeps increasing to the loan balance until after 20 periods we hit at 100,000. Now, guys, I'm off 40 cents because I'm doing something goofy with my tenths and hundredths. You know, my 40 cents is something with, you see how you really don't pay 64.02 for a thing, so that's where I'm off here, the 40 cents. Does this make sense, what I'm trying to show you? Do you understand the way that you'll figure out the journal entry is if we're doing the first payment, here we'll be able to figure out what the interest rate is, what the discount is, what the cash payment is. So as you see here, the first payment is going to be an interest expense, $93,205 times 4%. The cash is always going to be $3,500, and the discount on the bonds payable is going to be the difference. And we can go to this installment table, amortization schedule, and you can see it right here. Does that make sense? The next payment, here it shows. If you go here, you see we took the $93,205, we added that discount to increase the balance. Our cash stays the same, and our discount on bonds payable increased ever so slightly. Went from $228 the first 6 months to now $237. Do you see how we're getting those figures? Yes, no, kinda. How many of you guys are following me? How many want me to go over this a little more? Okay. So what's happening here, guys, is when the face amount of the bond here shows $100,000. The stated rate on the bond just tells you what they're going to get in a payment every 6 months. But the market rate really shows what's going on in the world. If the market rate is the same as the stated rate, it's easy. You're going to just issue those bonds at what shows on the bond, the face amount, $100,000, and then every single 6 months, every payment, the interest payment equals the amount of cash you got. Very easy. But if the market rate varies from the stated rate, either up or down, it creates a different scenario. An investor is not going to pay $100,000 and get a 7% interest rate if the market will bear 8%. Don't you want that extra percent for 10 years? Hell yeah. Which means the way they do it, that cash amount you get every 6 months is etched in stone. So the way we have to get that extra money is you are going to only pay $93,000 for a $100,000 bond. So, and we calculate what you're willing to pay by Excel, by the present value of what that money's worth today. So, if you're only going to pay $93,205 for a $100,000 bond, that extra is called a discount on bonds payable. And that discount will slowly get used up, which will slowly increase the face amount of these bonds to $100,000 within 10 years, by the 10th year. Your amount that you receive in cash will always be $3,500 with this example. It will never change. But your interest amount is more than the stated rate per se. Therefore, we calculate the interest expense is greater than the cash they're giving you, which is why you're only paying $93,205 for it. Okay? So the way that we amortize this bond is we show the interest expense, we show the cash, and the difference, the discount gets plugged in every 6 months, and this gets added to your loan balance. Okay? Do you see the loan balance? The carrying balance on the loan for the first payment was only $93,205. For the second 6 months, it was the $93,205 plus the $228. Then you're paying more interest. The cash is the same, but that discount on bonds payable goes up again. And it will continue to go up and up and up until in the 20th payment, it goes to $100,000. Okay? Make sense? Guys, the opposite happens with a bond issued at a premium. Okay? So this is showing what we just did. The amortization schedule for when a bond is issued at a discount, how the cash payment always stays the same. The interest is increasing until after 20 payments, your carrying value is going to be $100,000. Now, guys, when bonds are issued at a premium, the opposite's going to happen. In this case, they issued $100,000 of bonds paying 7% interest rate for $107,439. The bonds payable are only going to be $100,000 at term. And in this case, we have a credit to a premium on bonds payable of $74.39. So let me show you how this works. What was the number? 107,439? 107,439. And this is 3%. And this is a premium. So this is going to be the face amount times 0.03%. Look what's happening here, guys. We started at 107,436. 107,436 times 3%. Do you see our interest payment is only 32.23.34, 14? But look what we're getting, 3,500. We're getting more than the interest, which is why we're having to pay more for this investment. So it's the face amount carrying value started at 107,438. After 10 years or 20 periods, it's down at 100,000. Okay? So the first journal entry for the first payment is going to show interest of 32.23.34, 14, excuse me. The cash payment of 3,500. And then we're going to have a premium on the bond of 276.86, as you see right here. This is showing the issuance of the bonds, and then the first payment is going to show your interest. It's going to credit your cash, and the premium on the bond payable will be debited every single time. The next time, the interest goes down a little bit, doesn't it? Because the bond carrying amount's going down. The cash payment stays the same, but the premium is going up. Any questions on this? Remember, we showed the carrying value started at 107. After 20 periods, do you see how it ends up being 100,000? Yes? No? No matter which way we do it, if we issue them at a discount, 93, or if we issue them at a premium, 107, or face value, at the end, no matter which way, the end maturity date, the bonds will be at 100,000. Okay? When bonds issue at face amount, the carrying value and the corresponding interest expense remain constant over time. When bonds issue at a discount, the carrying value and the corresponding interest rate increase over time. And when bonds issue at a premium, the carrying value and the corresponding interest rate decrease over time. So here we have, on January 1st, 2018, Splash issues $500,000 of 9% bonds due in 20 years. Okay, stop right there. What's the payment we're going to get every 6 months? 500,000 times 4.5%, right? That's all we're using that stated rate for. $22,500, right? That's it. Assuming the market interest rate on these are at 10%, which means the market is higher than the stated rate, it tells us we're going to issue these bonds for $457,102. That's where we begin the amortization schedule, is the issue price of the bonds. So, to complete the first 3 rows of an amortization schedule is right here. I'm going to run to the restroom. I want you to attempt to complete row 4, 5, and 6. Okay? Try it. I'll be right back. Does that make sense? Okay, so guys, what would be the next row? June 30th, 2019, right? The cash paid is $22,500. What would be the interest expense? $22,891? $22,895? I'm sorry, 891.5. Thank you. And then the carrying value, wouldn't it be the difference between the 22,891.5 minus the 22,500? And 391 and 0.5. And then wouldn't the carrying value increase? And then the next row, do you see the cash amount stays the same? The interest is now going to be based on $457,830 plus the whatever y'all said the increase in the carrying value was. Does that make sense? And then you do it again, and you do it again. Guys, the amortization schedule really helps in doing this chapter. Because instead of getting like lost with what year are we in or what, just take the time to do the amortization schedule. So again, I'm a visual person, so it helps me to make sense of where I'm at. Okay? Now, what they want us to do is record the bond issue and then the first two semi-annual interest payments. Well, guys, if you have the amortization schedule, it makes it easy, doesn't it? You know where to grab the numbers. So the payment, record the bond issue on January 1st and the first two annual interest payments, we would show the recording the bond issue, we would show cash of $457,102, wouldn't we? We would show the discount on bonds payable to be the difference between the $500,000 and the $457,102. And we would show bonds payable to be $500,000. Then the first payment, we debit our interest expense for $22,855. We credit our discount on bonds premium, our discount on bonds payable for $355, and we'd credit cash of $22,500. Make sense? Which of the following statements is true for bonds issued at a discount? B. Excellent. I'm holding off for the retirement until next week. When we come back next week, we're going to go over this again. We're going to do some problems again. Then we'll deal with retirement of bonds. How are you doing? Do you understand why I let this go for 2 weeks? Next week, guys, enjoy your week without any homework in this class. Savor it. I do have, let me just do something real quick.